Back into corporate taxation. So we're looking at special deductions. So we've got the dividend received deduction, commonly abbreviated to the DRD, net operating losses, NOLs, and how deductions get um, calculated. There's a certain order to it. So moving on, dividend received deduction. So the taxpayer may deduct dividends received from stock owned in another company, subject to limitations as follows. So less than 20% in the other company, you get a DRD of 50%. Between 20 and 80%, that goes to 65%. If it's greater than 80, you get 100%. Now what that means is if I own stock in another company and I get a dividend of 10,000, if I'm less than 20%, my deduction for that 10,000 would be 5,000, 50%. If my ownership is between 20 and 80%, it would be $6,500 deduction. And if it's greater than 80%, then I would get a 100% received deduction, right? So I wouldn't recognize the dividend received of 10,000. It would be wiped out by the dividend received deduction. There are certain limitations that exist with this, which we'll get into, but this is generally how this works. So other DRD issues, exceptions to the limitation. So a DRD is 100% for the affiliated groups. You do get the 100% DRD for dividends received from foreign corporations if the taxpayer owns at least 10% of the foreign corporation. So they don't have to do between, less than 20, between 20 and 80. They just have to have at least 10. You don't get a dividend receipt deduction for debt finance stock. That prevents the taxpayer from taking an interest deduction but avoiding recognition of dividend income. And there are net income limitations. Other issues, you don't get it for stock held for 45 days or less. That testing period begins 45 days before stock becomes ex-dividends and runs for 90 days. This prevents a taxpayer from taking a DRD and then getting capital loss from selling the dividend. Ex-dividend means that the purchaser is not entitled to a previously declared dividend. You don't run into this one a whole lot. You do run into some of these. I've seen the 10% for a foreign corporation. Generally, people aren't receiving deductions for stock they've held less than 45 days, but it does exist. Getting to carrybacks and carry forwards. You'll have fun with this because the Tax Cuts and Job Act kind of mucked it all up. But NOLs created 2017 or prior, those can go back 2 years or carry forward 20 years. These NOLs expire after the 20 years and become permanently non-deductible, meaning use them up. NOLs created after 2017 can't be carried back, but can be carried forward indefinitely. These NOLs can offset only up to 80% of taxable income. I think we covered that in Chapter C2. And NOLs created 2017 and prior are not subject to that 80% limitation. So that could offset up to 100% if it was created prior to 2017. The CARES Act, another fun thing to get into, temporarily permits NOL carrybacks. So 2018, 19, 2020, those can be carried back for up to 5 years and they're not subject to the 80% limitation, but carry forward still do. We're past the CARES Act, so we don't super need this information, but the CARES Act kind of changed the rules for a little bit. And finally, sequencing the deductions. So there's an order by which the taxpayer takes the categories of deductions. So all your Section 162 deductions, right? That's all deductions other than charitable, DRD, and NOL. And then you do charitable contributions. Then you do your dividend received deduction. And then finally, you get your net operating losses that are carried back, or it'd have to be carried forward if we're talking current year. Okay, getting into controlled groups. There's certain rules that apply to this, but generally we're looking at the 80% rule that we kind of looked at for Section 351. Losses on sales between members of a controlled group are deferred until the asset is sold outside of the group. Entity is part of a control group if the parent, subsidiary, or other members of the control group own at least 80% of it, and that membership gets tested on 12/31. And you must also have been a group member for at least half the year. So if you fall into this controlled group where it's, you've got two entities that are commonly owned by at least 80% of a parent group, we can't trade assets back and forth and recognize losses. That is deferred until it's sold outside of our name. So here we've got some examples of what the parent subsidiary control group looks like. So here you can see the parent corporation owns 80% of Axle Corporation. So this is a parent subsidiary control group. But the parent also owns 40% of Wheel Corporation. And Axle also owns the other 40%. So therefore, because this is 80 and parent corporation indirectly owns the 40 through their own, 40 through Axle, this is all part of a control. Here we've got Art, who owns 50% of the Able Corporation, 50% of Coast Corporation. Then you've got Barbara, who owns the other 50%. It's like they own 100% of the Best Corporation. So this is the combined control group. There's also brother-sister groups, which the slides don't get into, so I'm not going to, but there's generally 3 groups. It's parent subsidiary, brother-sister, combined control. Here we're getting into consolidated returns. We'll get into the advantages and disadvantages of that and also what it entails. But the criteria, the common parent must own 80% of the stock, voting and value of at least one other corporation. The group must own 80% stock, voting and value of any affiliated corporations. And this does not include any foreign corporations, insurance companies, tax-exempt organizations, S corporations, or partnerships. And what this really is you've got a group, but you're filing just one tax return. So advantage to filing a consolidated return, losses of one member can offset profits of another, right? So if I've got a consolidated return and I own 80% of these two companies and one has $100,000 gain and one has $100,000 loss, I don't report those separately. They get combined and they offset. Capital gains and losses can be combined across the group, and intercompany profits and gains can be deferred until triggered. Again, that's changing between companies. You don't recognize that right away. That's not part of your calculation for the consolidated return. It's only when that asset or inventory or whatever gets transferred outside of the group is it recognized. Disadvantages of filing a consolidated return. The election to file a consolidated return is binding upon subsequent years unless granted permission to discontinue by the IRS, so you have to specifically request it. Intercompany losses are deferred until triggered, right? I can't trade back and forth with another company in this group and expect that I get to recognize the losses and they get to recognize the gain. Those are deferred. It's like they never happened for consolidated purposes. Losses from one member may affect the deductions and credits of another member, right? It's because we're combining everything into one big pot. I might lose out on something because someone else in the group affected it. Limitations on utilizing net operating losses, section 382. One corporation cannot acquire another corporation and utilize the acquiree's outstanding NOLs to offset the purchaser's income. Chapter 78 had more in-depth discussion of it. I can't purchase a loss company and expect to offset that my income. And that's really what it's trying to say, is that you've got a company that's been hemorrhaging money and it's constantly losing. I can't use their NOLs to offset. We're going to get into compliance issues, estimated payments, requirements for filing and paying taxes, and tax return schedules. Estimated taxes, and again, we're talking C corporations, not individuals, must pay in quarterly installments, 25% of the required due. For large corporations, must pay 100% of this year's liability, although first quarter based on the prior year. That's because first quarter kind of falls at a new time. Take into account AMT and regular tax and terminal liability, and payments are due on 4/15, 6/15, 9/15, 12/15 for county taxpayers. Penalties for the underpayment of estimated tax. Section 6621 imposes penalties on the deficient amount that was underpaid each quarter. The penalty charges run from the time the amount should have been paid until they are actually paid. Kind of unthinking word. Rate is the short-term federal rate plus 5%, and then you use Form 2220 to calculate your underpayment. Basically, it's taxes owed when it is due. You don't get an extension to pay. You can file extensions to file, but you don't get an extension to pay. It's due when it's due, and they're due on 4/15, 6/15, June 4th. We've got book tax differences. So arises when financial accounting reports an item differently than what is reported for tax. Think section 179. Section 179 is a tax depreciation. There is no such thing as 179 for book purposes. Permanent differences are income that's never recognized, reductions are never taken. So examples, meals and entertainment, taxes and interest. You recognize that for book, but you don't recognize that for tax. And that becomes part of your ASC 740 calculation. So in addition to permanent differences, we also have temporary differences. This is income that will eventually be recognized or deductions taken, but at a different time in the other system. It's a timing issue. Tax depreciation, that's accelerated, 179. Differences in tax first book basis, and then you've got tax carry forwards. So it's really two separate set of books. You're maintaining the book, which you would recognize meals and entertainment and tax exempt interest. But for tax, you don't get to take those deductions. So they're permanent differences. Tax provision, that is broken down into current and deferred. Current ties into what is actually due to the IRS the year that you're preparing the return. Deferred is associated with your book tax temporary differences in a state and local component. So there's going to be state and local taxes on it. And for sure, state, not necessarily local. And I guess if you're in a state that doesn't have income taxes, that is what deferred is referred to. Current is current, deferred is this difference happened earlier, and we are deferring that gain. The deferred component can further be broken down into deferred tax assets. That would be a refund that I'm deferring, or deferred tax liabilities, and those go on the balance sheet. Rules of the provision are dictated by ASC 740. That's kind of how we calculate it. It's issued by FASB. Major components, current tax liability due to the IRS or an asset, a refund from the IRS. The DTA or DTL associated with temporary differences and carry forwards. You reduce the deferred tax asset by the amount the taxpayer does not expect to get based on research and valuation. And then you have a liability for uncertain tax positions, which we'll get into here shortly, but it's more likely than not. So you got to meet the 50% requirement for the uncertain tax position. So here we have an example of a deferred tax asset. So taxpayer, tax credit carried forward of $1 million. However, the taxpayer is running losses and may not be able to use all of the credits before they expire. There is a 48% chance that some or all of the credits will expire. The taxpayer needs to reflect the DTA of $750,000 based on its analysis. So here's our journal entry. So we've got a debit to deferred tax asset of $1 million. That's our credit carry forward. We've got our valuation allowance of $250,000, and then our actual deferred federal income tax expense of $750,000. So uncertain tax positions. The taxpayer may take certain positions in its tax return, which may or may not pass IRS scrutiny. FASB may require the taxpayer to reduce or eliminate that tax benefit. The taxpayer cannot recognize the tax benefit for financial accounting purposes unless it is more likely than not the position will be sustained. then that's a cliff. If it's below 50%, then no tax benefit. If it's above, then some or all of it, right? But there is that cliff. If it's more likely than not 50%, you get to receive some benefit or all of the benefit. If it's not, you don't. Journal entries for the uncertain tax positions. So we've got, in this example, current federal income tax expense of $1 million. We've got a liability for unrecognized tax benefits, and then our federal income tax payable is 800,000. If we were to record the uncertain tax position below the more likely than not threshold, we've got the liability for unrecognized tax benefits of 150,000, cash disallowed of 50,000, and current federal income tax expense of 100,000. So the tax revision process, we ID our temporary differences, if those get added back. Prepare a roll forward schedule of temporary differences that tabulate cumulative differences and current changes. Apply statutory rates to schedules to determine your ending balances of deferred tax assets and deferred tax liabilities. You adjust those by valuation allowances, and then you adjust your income tax expense for those uncertain positions. You determine your federal tax payable, you determine your federal tax expense, prepare your journal entries, prepare your tax provision reconciliation. So that's reconciling your book difference to tax. You prepare your tax rate reconciliation, you prepare your financial statement. I do have an example of what this can look like. Just to kind of give you an example, this can get fairly complex fairly quickly. There's a lot involved with the ASC 740 calculation. Okay. Yeah. So here, start with our beginning balance of our accrual. So this is kind of what this slide is talking about. This income tax provision. So the idea are temporary differences. So here are our temporary differences: book tax depreciation, book tax difference on gain loss, and that's it. Penalties, not deductible. That's a permanent difference. Non-deductible dues, permanent. Entertainment, we don't get to recognize that. That is a permanent difference. You can kind of see how you're kind of almost preparing the tax return without really preparing the tax return, but you're looking at your temporary differences, permanent differences. What do I add back? That gets you to your provision where, okay, in this scenario for federal, we're looking at a federal refund of 29,000. That gets added here, and I've got formulas for it. This is typically how you see a lot of people do it. They've got software that can kind of do this, but if you know your way around it, you don't need to do that. You can do it by hand. And then you get into deferred rates. And so here's our corporate tax rate, 21%. Minnesota is 9.8. And then we're kind of looking at our changes in accrued officer wages, officer life insurance. And yeah, that's the differences that calculate cumulative differences. I'm not going to get super far into the ASC 740. My master's program offered an entire class on it. I'm only going to kind of touch on the basics. And here, the tax revision process is going to give you a pretty good idea what that looks like. These 11 steps here, it's going to give you a good idea. You know, if you're actually preparing one, it gets pretty involved. That covers chapter 3, corporate income tax. You can see there's a lot to it. Some of it is going to be similar to individuals. You know, use section 162, you know, Schedule C, sole proprietorship, also subject to the same rules. But there's other things that get involved with it, especially when you're getting into the income tax provision and deferred income taxes payable, all that fun stuff. All right, that is it for this week. Thank you, everyone.